In this session, we will discuss at a very high level what the financial system does. We will begin by introducing borrowers and savers. We will then examine how funds flow through the financial system and how these funds are exchanged for financial instruments. Our starting point is an economic agent that has a funding need. This could be a business with a profitable investment opportunity. Now, this business could dip into its cash reserves or even sell assets to fund this new investment. However, these internal funds might not be enough. In this case, it might make sense for the business to be a borrower and raise external funds from savers. Okay, here are our savers and our borrowers. Borrowers can be just about anyone. Households that need funds to buy a house or something at the shops. The business that I just mentioned may have a short-term working capital need or require longer-term funding to expand operations. Farmers might need money to buy tractors. And of course, the government might need to borrow to fund public goods. Savers are mostly households with more income than current spending needs. These savings can be put towards retirement. This often happens through a pension fund or a taxable mutual fund. They can be put in a bank, which is also useful for managing cash. And rather than spending more today, households can save for a rainy day by buying insurance. Now here comes the financial system. At a very high level, and this might sound weird, the financial system connects savers and borrowers. By connecting them, the financial system channels savings to meet the funding need of the borrowers. The end game here is economic prosperity. The financial system channels resources to their most efficient uses, and this leads to economic growth. In exchange for their funds, savers receive these financial instruments. Let's talk about them in more detail. A financial instrument is basically a formal commitment to repay. I give you some money, you have to repay me next week. We can be more precise. It is a legally binding obligation that courts and governments will enforce if something goes wrong. It requires that funds are transferred between participants under certain circumstances. I am repaid fixed amounts on certain dates. I am paid a lump sum if I accidentally crash my car, and so on. That's quite abstract, so let's consider some examples that we all know. Let's start with the savers. We are all familiar with a bank deposit account. As a saver, we put our cash in the bank. These funds are redeemable on demand. This means we can get our cash back whenever we want. Bank deposits are also safe and convenient. Instead of paper money, we can use checks or debit cards or mobile banking to make payments. With a mutual fund share, I exchange my money for a share in an investment portfolio. This helps me store and maybe even grow my wealth into the future. Insurance is another form of saving. Let's say I'm worried about a car accident. What can I do? I give up some spending today and pay an insurance premium. And then in the bad state of the world, when I crash my car, I get a payout. This insurance payout covers the costs of fixing my car. Insurance is a type of financial instrument that allows our savers to transfer risk. What types of financial instruments do borrowers use? Equity. A business owner can sell shares. This will pull in funds today. The buyer of the equity now has a stake in the firm. This entitles the buyer to a share in the future profits of that firm. When we think of borrowing, we usually think of debt. Bonds, bank loans, mortgages. Here, a borrower usually gets a lump sum today and then promises to repay in the future. The payments are usually fixed amounts that happen on fixed dates. That's why these financial instruments are sometimes called fixed income. Government bonds used to have coupons attached to them that could be torn off and redeemed at a local bank for a cash payment. There can be strings attached. With a residential mortgage, that's when you get a loan to buy a house. The borrower usually posts the land and the house as collateral. These are all financial instruments. They are all inventions, sometimes called innovations of the financial system. You might be thinking, why do we have so many financial instruments? Well, they are tailored to meet the demands of savers and borrowers. As savers, we value convenient ways to store and grow our wealth. Just hanging on to money probably doesn't make sense for most of us. We may also be afraid of some adverse events and want to buy insurance. Borrowers want long-term funding. They might be happy to raise money by issuing debt. Some business owners might prefer to cash out by selling equity instead. All right, let's sum up. The financial system sits between our savers, who have funds to spare, and our borrowers, who have an investment need. The financial system channels those funds from the savers to the borrowers. It exchanges funds for financial instruments. These financial instruments are designed to meet the needs of savers and borrowers.